Welcome back, ladies and gentlemen. No session is complete without a view on the macro trends, and we have a panel today that will make a business case for a positive macroeconomic scenario. We have with us two moderators for the session. We have with us Mr. S. Srinivasan, who is the Managing Director of Kotak Alternate Assets. He's been with the Kotak Group since 1993 and currently heads the Kotak Investment Advisors, a wholly owned subsidiary of Kotak Mahindra Bank. Welcome, Srini. We also have with us moderating the panel Siddharth Pai, the founding partner and CFO of 314 Capital, an early stage venture capital fund which is based in Bangalore, India, with assets under management of over $100 million as of 2019. He's an expert policy member at iSpirit, a leading startup think tank in India that has worked on the India Stack. He's also a member of the Regulatory Affairs Committee of IBCA. Welcome, Siddharth.
It's a pleasure to be here.
We also have with us other panelist members. The first of all, Neelkant Mishra, who is the Managing Director, Co-Head of Asia Pacific Strategy and India Strategist, Credit Suisse.
Hi, guys.
He's been rated among the best analysts in India. I haven't finished your introduction, Neelkant, by the Institutional Investor and Asia Money polls. He's part of the Economic Advisory Council to the Prime Minister and has been an advisor to several government committees. His report on the unicorns is very, very interesting, by the way. We also have with us Soumya Kanti Ghosh, who is the Group Chief Economic Advisor, State Bank of India. Dr. Ghosh has been a co-author in pioneering work to capture payroll data in India for the first time, both formal and informal. And following his report, EPFO and ESIC has started to give out monthly payroll data. Welcome, Mr. Ghosh. We also have with us Sharad Sharma, co-founder iSpirit Foundation. Sharad's mantra is to lead ecosystems and companies through an orbital change. He has 3 decades of experience in the internet, enterprise, software, digital finance, and digital healthcare sectors, and is a prominent voice in the India's technology ecosystem. Welcome, Sharad. And lastly, we have with us Mr. Praveen Agarwala, who is the co-founder of Better Place Safety Solutions. Praveen Agarwala leads the India's largest tech platform for blue-collar workforce management, which was launched in 2015. And before this, Praveen has worked with SAP as the Vice President and Global Head of Business. Welcome, Praveen.
Hi, everyone. Pleasure to be here.
Now I just give it off to you guys to lead the session. All the best.
Perfect. Thank you so much, Rashad. A very good evening to everyone. So I think before we start off this panel, it's important to set the context from where all of us are currently. The world is now actually emerging from COVID-19 in various steps and various phases. As it been the onset of the disease, even the offset that's happening right now, it's actually happening in phases throughout. But the indelible mark that COVID has actually left in the entire world is in numerous ways. First and foremost is in terms of health, and everyone's now introspecting about the healthcare infrastructure that exists within a country. Resilience has now become the word that every business, every enterprise, every organization, and every individual has at the top of their mind right now, and what is the best way to actually mitigate and prevent these sort of situations from happening as well. And from an economic standpoint, I think all of us have been introduced to an entire alphabet of recovery. From the K-shaped recovery, from a W-shaped recovery, from an L-shaped recovery, a U-shape, a V-shape, a W-shape, and basically every other letter that actually exists in the entire lexicon as of now. And in terms of context as well, what COVID has actually shown to the entire world is that the concept of money has become even more abstract than what it was previously. For the US actually created India's entire GDP in the span of one day. And what the Federal Reserve has actually created, unleashed on the entire world, the Federal Reserve as well as the Reserve Bank of India and all the other central banks, has actually seen a massive inflation happen, not just in terms of assets, but we've seen that happen in terms of commodities and everything as well. Growth has also been skewed to a very large extent, where some of the more traditional industries such as tourism, etc., have taken a huge hit. Whereas the tech industry, which has been India's mainstay from a startup ecosystem perspective, has seen the greatest shot in the arm, doubling the number of unicorns in the span of 1 year compared to what India had actually read over the past 10 years itself. And throughout this entire thing, we've seen that alternatives are now actually become mainstream as well, where startups used to be a curiosity that several fund managers and most of the economists will look about. And now we've had Mr. Neelkant as well actually come out with one of the most definitive reports on Indian unicorns also. And when it comes to this as well, and the ability for startups to actually create jobs and to create greater value, not just in terms of valuations, but in terms of actual gross economic value added. We see Mr. Samarkanti Ghosh actually speak about the number of jobs that have actually come out as part of that itself. We have Mr. Praveen also, Mr. Praveen Agarwal from Better Place, who's actually mapped out the migration patterns that between the organized and unorganized sector. And a large amount of this used to be driven by traditional industries, but now we've actually seen the likes of the gig economy actually explode and actually become its own mainstay in the global economic aspect as well. And throughout the entire pandemic, the role of technology has now become paramount. And we have Sharad Sharma from iSprit who's actually helped and worked with the government and worked with regulators around to create the most strongest technology backbone in the entire world in terms of the Bharat stack, in terms of the India stack, as well as in terms of UPI and what everything actually entails. So we've seen growth out of $42 trillion of bonds in the world right now. Close to about 24 trillion of them actually have a negative rate. Growth has now actually become at a premium when it actually comes to it. So this is the context, the global context when it actually comes to the business case that everyone has. And this is the world in which we now actually inhabit. Mr. Neelkant, I would actually like to come to you first. From 2019 all the way to now, we've actually seen innovation going from being a buzzword that everyone actually spoke about to something that the world actually had to grasp and get familiar with in a very, very short time. We've seen business models actually getting disintermediated and actually decoupled throughout the entire process. And we've seen unicorns and upstarts and startups actually challenge the established order. What do you believe is going to be? How do you believe this flux is actually continue over time? And when do we finally see this flux actually start? I would say stabilizing to a large extent, and the frothiness in the market in terms of valuations, the frothiness in the market in terms of uncertainty actually coming to some sense of warmth.
Yeah, thanks, Siddharth. The way I would look at this whole ecosystem is as having received a lot of risk capital. Right? So India has never been short of entrepreneurs. If you think about even the 1980s, the growth in the number of companies registered was in double digits, right? It was even in the midst of the biggest or the worst of the license Raj, people were registering new companies. The problem was they didn't have enough risk capital. And what it allowed you to do, what risk capital allows you to do, is to experiment fast and fail fast. So the time horizon gets compressed. So if you read about this dairy company which was started in 1971, it took him 50 years to reach a valuation of $2.5 billion because he was reinvesting his savings from 1 year into a risk capital for the next year. This has now been totally galvanized because now new entrepreneurs are able to test out new ideas much faster. And I see this as not a one-time occurrence. I see this as something that has changed materially. When you're a poor country, availability of risk capital is a challenge. When you start becoming wealthier, so if you look at the number of millionaires in India right now, it has shot up dramatically, right? Because of the culture of stock options, but also just because India is now a much richer country. And that means that the availability of risk capital is no longer a big constraint. So I don't see this as ending. The question on, and actually the scope, because of what Sharad and his team have done, because a lot of other changes that are happening in terms of everyone having a bank account, new layers being created, now the account aggregator model. A lot of the problems that India had where the fixed cost was perhaps too high for an economy with our per capita GDP, that fixed cost of when does an account become viable has been collapsed. The fixed cost of what it takes to evaluate a loan has collapsed. And I think that is very promising for India. That creates a very fertile ground for new companies. And last point on valuations. See, valuations are about herd mentality. Right now, I think we are one accident away from this whole thing collapsing. Right? So there is people are fudging numbers. People are overstating their revenue, saying, "Oh, why don't you pass through this my P&L? It'll add to my GMV anyway. I mean, I will not add even a rupee to that. My GMV will go up. I'll get a higher valuation." That drama, so it'll be higher ups and higher downs. So that's the way I look at it. This drama will end, I think, in 3 to 6 months. Then we'll have 1-2 years of a drought, and then the whole thing starts up again, because it is not being built on thin air. Let me tell you that. The investors who enter now will damage their portfolios. But the point is that the underlying businesses, some of them are real businesses, and they are solving real problems. I'll stop there.
No, I think that's actually very true. The moment the tide actually recedes, everyone can see who's actually been swimming naked, and that was actually true in the start of the pandemic. I think that's actually going to become true, as you said, in about 3 to 6 months as well. Mr. Soumyakanti Ghosh, your team actually released a great report, which actually said that all the people who put their money into their savings bank account as of now because of inflation have actually seen a loss in terms of the real value of the money that they actually have. And this also feeds into the issue I spoke about previously, where in terms of the entire world as well, a larger proportion of all the bonds actually have a negative yield as opposed to a positive yield as of now. So the entire growth patterns actually skewed to a large extent. And we're actually seeing this, and we're actually seeing what is the mainstreaming of alternatives that's actually arising as part of that, as part of this entire scenario, with startups actually leading the entire way when it actually comes to this. Do you believe the depression that we're seeing in terms of the interest rates right now with actually something that's going to continue going forward? Because we've seen this happen in Europe and more developed countries as well. As India actually reached that inflection point right about now, and how can even the real saver or the average common man actually start tapping into this wider startup ecosystem to ensure that they can also protect their savings, and they can also grow their savings over time?
Yes. No, I think that's a very interesting question, Siddharth. I will answer in several parts, but that will be short. The first thing is that I think the total amount of deposits in the bank today is around 150 lakh crores. And the total amount of credit is around 110 lakh crores. Now, out of this 150 lakh crores, the total amount of retail deposits, which includes the senior citizens, is around 107 lakh crores. So and given the fact that India is a country which doesn't have a social security, so there is always an option to protect the interest of the depositors. So this is of this, at least the senior citizens. Now coming to the second point, the important point to note is that I think, and this will actually take me back to the linkage between the financial market and the stock market, because that is where the entire linkage ranks. I think for an extended period of the last 1.5 years, as you know, that the bank deposit rates has been at very low rates, and that has been done because the central bank, the RBI, has injected around 17.2 lakh crores into the economy since the beginning of the pandemic, which is now slowly withdrawing. Given this fact, the important point to note is that even after all this, I think the developments which has happened, the total amount of household financial savings that is going into equity and mutual funds in any particular year, we calculated that number. That number at the end of March 2021 was possibly around 2.5 lakh crores. Now, total household savings, if you take as 30% of India's GDP, so that gives you one number which is at 200 lakh crores. There is about 50 to 60 lakh crores. So out of that, you can understand the percentage going into equity and mutual funds is still today 2.5 lakh crores. In the US, this number is at 333 lakh crores. So I am not saying we go to USA, but the gap between 2 and 333 is a large number. So that explains your point, is that this investment household financial savings in the stock market is possibly become a self-fulfilling prophecy, because interest rates are unlikely to go up in the near term for the next 1 year, and we'll relatively have a stable interest rate and a stable exchange rate also with some amount of fluctuation. So if that is the case, I think that could be the best option available to an household financial investors, because I mean, at the end of the day, it becomes a self-fulfilling prophecy. Then the myriad of disturbances in the stock market, on the financial market, which we used to see earlier, will not happen to that extent. So I think there is possibly a fundamental shift in the behavior of the household financial savings. In fact, I'll give a very interesting example. That day, my mates were asking that they would like to start investing in the stock market on a regular basis. So I think these are developments which we can't ignore. And if we have time, we'll come back to another aspect. I think all this is happening because of the formalization of the economy. There's one data which I would like to highlight, which is there in the public domain, but I don't know whether anyone has seen it, that the eShram portal. Today, the data on eShram portal of the unorganized sector laborers shows that 3 crores of unorganized sector laborers have enrolled on this, and all their accounts are Aadhaar and bank link. So I think we are on a structural transformation of formalization of the economy, and a large part of this savings, which is also going to the stock market, is because of the formalization. But to cut the long story short, I think we are in a period of extended stable interest rate and stable exchange rate, even though there could be some increase in inflation or the other. But to me, that is the most important development today, post-pandemic, if you want to take the entire thing positively.
Very true, Mr. Ghosh. I think as part of the self-fulfilling prophecy, one of the seers of that self-fulfilling prophecy is actually Mr. Sharad Sharma and iSPRIT, because the ability for all of us to actually invest into the mutual fund and the amount of money going to mutual funds in the stock markets right now, and the ease with which it's actually happened, has actually happened because of the team that he has actually crafted and the work they've actually put in over the past 10 to 15 years itself. And the role of technology, Sharad, I would love to get your thoughts on how the technology went from being a curiosity a few years ago to now becoming an indelible part of an entire organization itself. And what India has done, which is unique, and this actually follows in terms of India's ethos, in terms of following the non-aligned part or the middle part, is that we haven't allowed the private sector to actually monopolize technology and create the digital public goods. But instead, we've had a group of volunteers, such as iSPRIT, actually create this entire piece itself and then actually put it forward. Because if this didn't actually exist, we'd be like the US, where you have 2 or 3 payment service providers actually having information across everyone. But whereas the systems we built out here have actually ensured that privacy actually becomes paramount. The flip side of that is something I would also love to get your thought on, is because in case that didn't actually happen, the ability for shareholders and the wider public to become part of that entire piece, and that greater value creation that would have happened wouldn't have actually been possible. So this is a sort of flip side of creating the digital public goods that actually goes as part of that. We'd love to get your thoughts on how you actually look at this entire dichotomy as well. What else you have in the back when it comes to creating this, maybe in terms of healthcare or something else, and how can investors and the rest of us on this call understand what's going to happen, so we can also plan our investing thesis also accordingly.
Right. So there are 3 things that are happening, and I'm going to talk about 2 of the 3 because I'm going to leave one for Praveen. So one is this whole informal to formal sector transition, which, Kanti also referred to, and it's a very important transition that is taking place. The second is from India 1 to India 2. And frankly, Jio showed us that that is a profitable way, to go. And now that is being replicated at a scale and stage that we often don't appreciate, right? During COVID, we have Zerodha, which has gone deeper in many ways, and many other startups have gone deeper that would not have been possible in an earlier era. And it's not been possible in other countries, especially if you compare us with Indonesia. And Indonesia hasn't seen this deepening of digital behavior in the middle part of the country or in the lower part of the country. So that is something very unique to India. And why is these 2 happening is because we are embracing a new innovation kind of an architecture for the country. And this is the innovation architecture which you referred to, Sid, where Uber is private innovation, but it exists because there is GPS, and that is a public platform, right? If there's no GPS, there would have been no Uber. Pfizer and Moderna are going to make tons of money on their mRNA vaccine, but that's been possible because mRNA wasn't funded by any VC. It was entirely funded by NIH and NSF up till this point, up till a couple of years ago, right? So you have this new architecture which is emerging, which is public goods, public platforms, private innovation. Now, the value of this is that it expands the market dramatically. So the private innovators can make a lot more money than would have been possible because the market expansion is so large. Now, they may not make money where the public platforms are. I agree with that. But they make money above that in a big way. Now, where is the opportunity in a big way? We in MSME sector, for example, we haven't given out enough credit. The 107 lakh crores that Kanti just referred to, very little of it has gone to the MSME sector. And that is going to change because, that's, all these public platforms are making that possible. And we are already seeing this. The pilot is running in Gem Sahe, where, believe it or not, private players, banks, I was surprised and shocked, gave a loan of 238 rupees. Now, at 238 rupees, they hope to make money. Nobody pushed them to do that. They hope to make money on a 58-day loan of 238 rupees to an MSME who had sold some chairs to some government buyer there, right? And so now that is going to just take off and explode in the years to come. And Ashish Gupta of Credit Suisse, Neelkant's colleague, and others have predicted that these numbers are going to be very large. And I believe that is going to be the case. So one thing I want to mention here before I go to health and finish it off is that this formula, this new engine that we are creating, is new for India. We should have actually embraced it in 1992. When Korea embraced this in 1974, its per capita income was less than Thailand. Thailand hasn't embraced this. Korea embraced this. You can't mention a Thai brand. You can mention many Korean brands. Korean per capita income is 5.6 times that of Thailand since 1974. The Israelis embraced it in 1988. The Chinese embraced it in, about 90 or 91. You had Japan embrace this in 1962. There is a direct correlation between having this innovation architecture versus the per capita growth that you have seen. India now has the chance to embrace this 30 years late, but nevertheless, better late than never. Now, where will it manifest? I think one of the other places where you will begin to see the impact of this is health. As you know, about 80% of our health spend overall is actually out of pocket of the individual. It's private sector, government part of the health system is relatively small, between 27 to 30% from a provider perspective, but from a spend perspective, it's even lower. And that is now set for a revolution in the next 10 years to come. So we have an opportunity to solve our hard problems in an Indian way with Indian entrepreneurs and Indian public goods. And that is going to open global markets for us. Remember, Ericsson and Nokia, they traveled to the rest of the world when the GSM standard traveled to the rest of the world. So Neelkant mentioned account aggregator, that is traveling to many other countries. When that travels to many other countries, there'll be people, companies from India, our Ericssons and Nokias, that will travel with it. That will hopefully happen with UPI as well. So these are some of the deeper factors that are at work. And, I'll hand it back to you and come back if there is time.
Perfect. So I think with that, one of the ambassadors of this entire change has actually been Praveen from Better Place, where Better Place has actually built a large proportion of their technology, etc., on what India Stack and everything's actually created. So Praveen, would love to get your thoughts on how we've actually built up Better Place, how Better Place now become one of the largest blue collar HRMS platforms in the entire country for that matter, and given the fact that this entire unorganized versus organized sector that's actually happening, what are your thoughts on how the migration patterns have actually been pre-COVID, during COVID, as well as post-COVID as well? Because that actually gives a fantastic insight into where the new hotspots of job creation actually become, and which are the sectors that are actually attracting them to the highest extent.
Certainly, Siddharth. And first of all, thanks to Sharad and iSpirit team for building that platform on which you can create some wonderful stuff like you mentioned. If you look at overall problem, and we all spoke about it, is the problem of data. It's the existence of data, which was completely missing perhaps 5 years, 7 years back. And today, that is taking the paramount effort that everyone is putting together. So what is possible today was perhaps not possible 10 years back, 5 years back, right? So what we do is that we basically provide solutions to enterprises that are hiring blue collar workers, but in that process, use the Aadhaar stack and other potential technology which is provided by the stack, and then build enough data about people into the system, which simplifies the problem of people, right? Today, the problem in blue collar economy, when we talk about around 150 million people in this economy in formal or informal sector, their problem, first of all, the problem is that they do not have access to opportunities, right? They do not even know where the opportunities are. If I have to go and apply for a loan, I get it. You mentioned about the small loan, but that's because there is some data available about the individual. But most of the people in the sectors that do not even have access to that kind of opportunity. If you have to invest in a small, for example, a lending solution or an investment, you are not able to do is because of the missing data completely, right? So what we are doing is building the data around the ecosystem, using HRMS as a tool to enter and provide all kinds of access to individuals through a distribution platform. I think most of the people are also changing, their aspirations are changing, and people are adopting technology much faster than what they were doing 5 years back. So it's not only the enterprises are adopting it, the individuals are also adopting it now. They also want. In fact, my domestic help the other day said, why don't you GPay my salary rather than giving it in cash? Because that is the level of adoption that we are seeing today, right? Now, when enterprises are adopting it, it is also pushing somehow the individuals to adopt it even faster, right? And pandemic, fortunately, in this case, has played a positive role. It's a fragmented environment, distributed. You are not able to travel anymore. You are not able to meet people. You have to manage it remotely. And the only way you can manage remotely is through technology, right? So that has played a huge role in this process. The other thing that we are seeing on the migration pattern that you spoke about, during pandemic, a lot of people moved back to their hometowns. Right? There are roughly 15 crore people in the country today who are migratory workforce. Right? Whether they're migrated from a small village to larger city or state. Typically, there are 6 states where most of the people migrate from, right? The northeastern states, we call it the manpower supplying states in principle, the Assam and the Odisha and the Bihar, where farming is going down. But during pandemic, they started moving back because of safety issues. But what you see actually is that as they move back, the e-commerce economy is also growing, right? There are multiple other things which are happening. So people also started finding local opportunities, which are not possible perhaps in past, but today it is possible. So earlier I used to come to Bangalore for doing a delivery job or a security guard job, but today perhaps I have a delivery or a warehouse opportunity in Guwahati or in Tejpur, which are the remote areas of Assam, or because of e-commerce where I can do multiple different things, right? But nevertheless, there are not sufficient opportunities. So we believe that 85% of the people have already come, they have come back to the cities in search of course, opportunities, right? But if you see the trend now, people are okay to travel 1,000 kilometers, 2,000 kilometers earlier. Now they are looking at opportunity which could be 100 kilometers or 500 kilometers away. So in case something happens, they have the opportunity to go back to their respective hometowns, right? And that's the trend that we are seeing across. The other good thing which is happening is that with the money coming in, right, the inflow, and fortunately, where the China certain things are blocked, the manufacturing sector is also going up. We also see these changes happening in UP, for example, right? There's a lot of manufacturing happening. People are actually shifting job from the traditional security to a manufacturing unit and upskilling themselves, right? So there's a lot of such, the changes which are happening across the ecosystem are, in my view, while migration will continue forever in some way or the other, but it will start reducing and people will start looking at localized opportunity more than it was in past, right? And that's a trend that we have been seeing. And that's the reason perhaps you find the resource crunch in cities today, right? The demand is increasing. People are giving incentives to people to just join just because the supply is drying up going forward, right? And I think one of the things perhaps that we have to also look at is how do we upskill people? And that's one of the things, in my view, is missing completely in the country today. And one of the plays that we have taken, that we will train 100 million people over the next 5 years in all the different skills and ensure that they are ready for the future opportunities as well. But that's one initiative where we have to really invest our time and money to be ready for the future opportunities. Sid?
So Srini, would love to get your thoughts on this. You see us as a vice stage.
I actually have a couple of questions for both Soumyakanti and Neelkant. Neelkant, I think your paper on which connected the dots between the kind of infrastructure, digital infrastructure that's been created and the physical infrastructure that's been created, which has resulted in capital flows. One of the questions that many of the people here in this audience is investors in private equity funds, long-term investors, and I dare say that these are investors who are investing in a riskier asset class than public markets, where once they come in, they have to take the performance risk of companies which are young, and they also take the country risk and the currency risk. Obviously, at this point in time, whatever is happening in China, a lot of people are thinking that India could become a mainstream capital allocation destination. While I'm personally not happy about that being the board on which we want to become a capital allocation destination, in your conversations with global investors, as you sort of convey the India story, we are at $3 trillion today. At what point in time do you think India will become a capital allocation, portfolio allocation decision by itself, number one? And number two, how should some of these long-term investors be thinking about the rupee dollar? Because it's not an investment that they can get out at the press of a button, unlike public markets.
Yeah, so let me answer the second one first. It's a lot easier. I'm not saying I'm a currency market expert, but macroeconomically, I think we are. It's easy to see where the rupee is headed. So there used to be this villain, which I think, given the vintage of all of us on this call, maybe Sid is an exception. I would remember Ajit, the liquid oxygen joke, right? The liquid is a jeene nahi dega or oxygen is a marne nahi dega. So the rupee is somewhere there, right? So the balance of payment surplus is so significant now. See, we've accumulated $170 billion in the since the end of FY20. I think going forward also, we are going to have a $35-40 billion balance of payment surplus. Our production capabilities are rising. IT services exports are now entering a new orbit. New areas like software as a service, where we've always aspired to develop software products, and now SaaS is giving us that opportunity. And so there is a lot of and increasingly, a lot of services in the US are now getting fragmented. See, you can only export a service once it becomes a part which is exportable, right? So if there are devices which can give you blood pressure, if there are devices that can give you stethoscope-like data, you can outsource healthcare. There's already a lot of outsourcing of education happening, right? So I think the balance of payment situation for India is going to remain quite robust. And so the rupee actually should be appreciating. But that's where the liquid oxygen comes in. The RBI won't let it appreciate, right? So I think the RBI will keep accumulating dollars. At some point, I mean, look at the decisions today on the liquidity, right? I mean, liquidity is being created because they've been buying dollars. But anyway, the point is that the rupee, I think, will remain range bound. The bias of the RBI is to let the rupee depreciate if they can. Unfortunately, with the BOP surplus, it's very hard to do that. I think on the riskiness of the investments and India as a standard portfolio allocation, one thing we have to be very clear on is that this surge in private equity investments that we are seeing in India is visible in other countries also. Because some of the platforms, I mean, and I'm hoping and praying that what Sharad was saying, that we start exporting some of our technologies, and we will have a natural edge when our companies will have a natural edge. But just the simple fact that processing computing capacity has become cheaper, memory is cheaper, telecom is cheaper, and therefore a lot of things are happening. Plus, if you remember 15 years back, or let's say now 12 years back, when this zero interest rate policy and QE, etc. started, the assumption was that bond allocations from pension funds will flow into equity allocations. That did happen, but for people like me in the public equity markets, it didn't happen to public equity markets, it went into private equity markets. And therefore, you'll see that private equity allocations across the world, so there's $800 billion coming in, right? And so we are getting 30, 40 maybe in India, but it's still a fraction. But as people see the success, remember, till 5 years back, it was very hard to find funds which had returned money at good returns.
Yeah.
Right? And now we are building that track record, right? So till you can show that you can invest money in India, because in 8 years, the rupee would have fallen by 30%, right? So right now we've had a stable rupee for 5 years. We are now starting to see the compounding effect coming in. There are a few vintage of funds of some vintage who have returned money, and therefore the attraction. I mean, why is anyway? Let me not name funds. I don't know if compliance will allow that, but there are funds which are now just destroying the discipline of valuation in the market. But the reason is that some of them have made their earlier funds have made money, so they've been mandated to give more money into India. So I think that change is happening, and as you become of a larger scale, right? So if you have 700 million internet, when I dabbled in entrepreneurship 20 years back, the problem was my idea was VXML, right? Voice XML, because internet hai nahi, so internet browsing on the phone. Now the point is, now there's 700 million, so the ecosystem is there. I mean, so I think it is already part of the standard set of countries that you look at, and the more businesses we seed and fund, the more standard it becomes. So that hurdle has been crossed. I don't think that's a challenge.
Great. Let me come to Soundya-Kanti Ghosh. I think one of the interesting points that you made was when you gave the statistics with regard to domestic savings, and of course, Sid made the point about real returns being negative in the bond markets and the public markets. Credit growth has been very, very tepid. Most of the credit growth, whatever little growth that's been there, has been on retail, probably fueled by technologies that have been mothered by Sharad and his efforts as iSpirit in creating the infrastructure to give small ticket loans as well. When are we going to see credit growth, manufacturing capacity, job creation in the conventional sense? While there is a lot of job creation in the in tech-driven sectors, there are two questions out there. One is the kind of jobs that we are creating, and second is capital output.
Yes. Now, I'll answer that question. I think just I'll add to Nilkant's point in a very, in a richer manner. I think today's monetary policy, the data which was announced, that shows that in the first 6 months, the total purchases by the central bank because of capital inflows into the country was around 3 lakh crores. That means around $42 billion amount of the dollar has been purchased by the RBI. So basically that means that this is also creating the liquidity problem. So today the joke in the market is that let the rupee depreciate a little bit, so that could actually suck out a little amount of liquidity if the RBI can sell some amount of dollars. So this is the way we are looking into the thing. Now coming to your specific question on these jobs, yes, I agree with this. I think one of the problems with India's job story, and first getting the credit growth, let me just give you some numbers again over here. I think in the 2004 to 2008, if you remember, in those days we used to have an analysis that the nominal GDP growth should be equivalent, the credit growth should be at multiple times of the nominal GDP growth. But I think that doesn't stand anymore, because what has happened is that if you look into the total incremental resource flow to the commercial sector, the share of bank credit has been significantly declining. In fact, this year also, the share of incremental credit from the non-bank sector is more than 60%, and the share of banks is around 32-33%. The point to note here is that taking advantage of an extended lower interest rate regime, corporates has been significantly deleveraging. Point number one, the total amount of deleveraging, for example, we take it as 2 lakh crores. The second thing which they have done is that there is also a significant amount of equity investment happening, which also is actually amount around 2 lakh crores. So if you assume that these two amount could have stayed back with the banks, then the credit growth actually gets back to the 10% if you add up this 4 lakh crore amount. So therefore, you will never get a situation whereby credit growth, say, will be a multiple of GDP growth at some point of time, because those days are gone. And I think that is good for the economy, because you are able to diversify your risk away from the debt capital. And regarding your employment, yes, there are concerns on the employment. In fact, there has been a lot of studies on this, why inflation has been stayed low for such an extended period from 2008. I am talking also about the global. In India, it has stayed at low levels from 2016 onwards. See what has been happening, and this has been happening globally also, because after what has been happening, that we have been creating a lot of low-end jobs. So, and these basically the problem is not of unemployment, problem is of underemployment. And given that we have been creating this low amount of jobs, there has been a significant amount of erosion of purchasing power, not only in India, in developed countries also. And that is the reason that why inflation has stayed put at this low region. And now there are arguments which are being shown by several academic economists saying that this could be an extended version. So my sense is that we need to we possibly are creating jobs which are at the low end of the market, and this we need to rectify. I think I would like to go back to one of the points that Praveen made in terms of upskilling. I think that is the most important point today. So while jobs are being created at the higher end also in terms of unicorns and other things, but at the low end, we need to do jobs. And I believe, and Neelkant has also written about this, and the PLI scheme the government has done, that is already showing some good amount of traction also in terms of foreign exchange earnings, in terms of exports and so on. And I think that's the way to go forward in terms of building up a manufacturing job. India must occupy the manufacturing space at least at the lower end, which China had vacated some time back. So I think that's the best way to move forward.
Sid, over to you.
So, thank you, Mr. Ghosh. Actually, with regard to upskilling, this is something that investors have been very, very bullish about. There's actually a very famous joke going about that India's education budget is 13 billion. And one of the most prominent edtech companies buying acquisition budget is also about the same in terms of being 13 billion itself. Sir, just one thing, this I'm actually bringing over to Praveen right now. Mr. Ghosh believes that the manufacturing jobs are actually the ones that will actually end up catapulting and leapfrogging India into a different orbital. But how do you see this play out with the increasing level of digitalization that we're seeing and automation we're seeing, especially in the manufacturing workflow as well? Previously, all of us have heard of factories in China and even in India now, where the entire factory floor has now actually become dark, because everything is now actually just going through an automated process as part of that itself. So with regard to upskilling also, would manufacturing be one of the best ways? And this is an open question to Praveen, Mr. Ghosh and everyone else as well. Would manufacturing be one of the best ways to actually go about it, or would upskilling and a migration into services actually end up serving also?
So in my view, Sid, that also depends on the base we are, right? So the base that we are is still very, very small. So for the automation to even kick in, you need certain strength, right? That strength is still not there. So that itself occupies large chunk of the opportunity, right? It could be in terms of millions, might be, I think potentially it could be 15 to 20 million people that we can look into this space of upskilling, right? In the manufacturing. So that has to be there. Of course, automation will kick in, robotics will come, but that also depends on what is the cost of manpower versus robot that you would like to have and what part you would like to automate, right? If you go to Germany, where everything is done in an automated way, or a couple of guys will be doing because the cost of manpower is very high, while here we would like to have 100 security guards because the manpower cost is lower. So that will also determine how things will shape up. But I think we are at a very low end right now. The base is very small and there is a huge opportunity, and we should not worry too much about what will happen. If you look at China, the reason the manufacturing is happening in China is not only that China is doing at a lower labor cost or other things, it's also because if you want resources, you get it, right? If you want people, you have it. Here in India, we find it very hard, right? If you want to set up a manufacturing plant for mobile, you will not get sufficient people that you like to have. And that is the preparation that we need to do, irrespective of automation.
Right.
Sid, I have a question which is more of a crystal ball question for everybody. Now, Sharad had mentioned earlier, and he had given the example of a 238 rupee loan to a manufacturer. Now, given all the architecture that we now have, and Neelkant's comment that we have now compressed the cost of delivering credit and the viability of that kind of business. And I combine that with the comment that Soumyakanti Ghosh talked about with regard to the total savings. And then you juxtapose it against the kind of risk capital that has come to finance all the startups. The hard truth is that 90% of the risk capital that has funded all these startups is actually foreign capital. And if unicorns are being created and if they're being monetized, and if they're being monetized in the public markets, to the extent of the 2% of domestic savings that is going into equity, is actually giving exit to these foreigners who have come and who have had greater faith in the Indian entrepreneur than the domestic savers. Now that we are able to democratize credit, how much of the democratization of savings and unitization will change the landscape with regard to channelizing capital to risk assets? I want a hazard. I want the economists to take a hazard, take a guess, and put out a number out there.
The first thing is that we need to, at least for the next 10 years, if not 20, be willing to let foreign capital come in. See, I think this tendency that we get 5 years or 3 years, I'm not criticizing you, and this is a general tendency we seem to have. And we start saying, why not, why are we like, all our big companies are in the listed space are all majority foreign owned. The biggest bank by market cap is 80% owned by foreigners. So, but the reality is that at this stage of development, so when the US was an emerging market, early 19th century, your savings have to come from outside. If you rely on your own savings, you are not going to be able to grow very fast, right? My father bought his first house at 55. I bought my first house in the early 30s, right? And the reason is I could take debt. And I think that we need to be very careful about not, being sort of discarding or stepping away from foreign capital. Foreign capital is necessary. I think it has to keep coming in. The second thing is that domestic capital. So we have to realize that it's always an asset allocation decision. See, 90% of equities. So while penetration of equities into household savings in the US is 30, 40%, 90% of equities are owned by the top 10% of the households. Equities are a risky asset class, right? And I'm talking public equity. Private equity is an even riskier asset class. You require long liquidity horizons, right? It is so as we see more wealthy people, right? What was our biggest problem? Our biggest problem 30 years back was that there were only a few people. If you wanted to set up a steel plant, how many people had $1 billion to set up a steel plant? Very few. Now you are seeing the entrepreneurs, first generation, they sold their business. Now they're starting a bank, right? And a completely bootstrapped bank. Phenomenal, right? And these are things that would not have been earlier. So I think we have to be very careful that it is only the top maybe 0.1%, 0.5% of India's households which can afford to invest or which should actually be advised to invest in private equity. The interesting thing and the useful thing is that that number is exploding. And the wealth available domestically, and most of these guys, most of my batchmates, juniors who have been running unicorns and who have created a lot of wealth for themselves are very avid investors, right? So one of them has invested in 65, another where both husband and wife are my batchmates have invested in 45, right? So I think this is the domestic capital available for venture capital and private equity is only going to go up. But we should be very clear that we should allow risk capital to come in because if it is coming as debt, I think it is something that we can debate macroeconomically. If it is coming as equity, what's the harm, right? There was this entrepreneur in the early 19th century who raised debt funding at that time. Private equity, venture capital was perhaps not available. Who raised debt funding from some Scottish savers for a country in Latin America which didn't exist. Right. So and there were state governments in the US which defaulted in 1830s and 1840s. So, but the infrastructure got built, right? So they built highways or whatever they built at that time. But the point is, they defaulted. They couldn't raise revenue. So paisa kiska gaya? Saver ka. Jane do. But infrastructure got built. So we need to be very careful about the foreign versus this mix. But I think domestic capital will come in.
I just want to add about this foreign capital. I think what Neelkant said, if you actually look into the gross FDI inflows into the country in the last 5 years, and if you want to break down into these FDI flows, equity which is coming into in the new age stocks, I think this number is a humongous number. I was calculating that day. I think that could be around 70 to 80 billion money has come in the last 5 years into all these new, and that's why the FDI numbers, if you remember, during the pandemic, there was a story that FDI flows had actually collapsed and declined across all countries, but India was the only exception where FDI inflows were last year also was in excess in the first 4 months. For example, this year also it has been very healthy. So basically, and I think FDI always has been at a lower part. It has been less than 10% of the overall total investment requirement. So from that point of view, this is a welcome departure that foreign equity capital is coming in. But also domestic domestic, just think of the opportunities. The numbers I'll just show you. 150 lakh crores is the total deposits. Total savings of India is around 60 lakh crores. If you're assuming that out of this 60 lakh crores of total investment, the household financial savings that goes into bank deposits is around 35 to 40%. So even if I take it as 45%, 35%, that is around 20 lakh crores. So out of 20 lakh crores, only 2 lakh crores or even less than that is going into equity and mutual funds. Overall deposits is 150 lakh crores. So even if this 2 lakh crores goes up to say 10 lakh crores or even 5 lakh crores, I think that is unlikely to take a major impact on the overall deposit pie in India. So therefore, I think this is also a welcome development, and that's why I said at the beginning that this movement in the financial market is possibly a self-fulfilling prophecy, because sky is the limit. At 2.5 lakh crores, if you compare with India, with other, I mean, I'm not comparing with USA, I mean, that's a separate ballgame, but the number over there is 330 lakh crores. So you can actually see how much amount of possible increase in this investment could go, and all this investment could actually be useful in India's infrastructure requirement at some point of time, because the way we are trying to build up the infrastructure, I think that's an important point we have to remember.
Sid, do you want to summarize?
No, I think Sharad had something to add over that. Would love to get your thoughts, Sharad. As one of the architects of this infrastructure project, would love to get your thoughts on this.
So I want to make 2 points. One is I agree with the sentiment we should let foreign equity capital to come in, which is very important. But you know what we have to prevent is that equity capital doesn't result in re-domiciling of our companies outside, because then it becomes very bad, right? So we know 74% of the SaaS companies, for example, are re-domiciled outside. And why is that? Because we got some inane, stupid laws, and regulations which need to be changed. And, we've been pushing collectively these 34 items in Stay in India checklist, and only, I think, 17 or 18 have been addressed. So it is time for the government to actually take a stand and get rid of the remaining, so that our companies are not forced to re-domicile for some inane, stupid regulation that exists here. That hurts us a lot, right? Because then when the company becomes wealthy, the equity capital will still go out, but now many other things go out as a result, right? So that's clearly one thing that we have to take care of. Second, from an economics point of view, I really would encourage our economists to focus now not just on factor productivity, which is important, and I think labor reforms can help, and some capital changes that are taking place can help, but on total factor productivity. See, we know the biggest contributor to growth in every country is actually the total factor productivity, roughly about 60%. And the only thing that we know about it is that is linked with the innovation model that the country has, right? And if we as India have to change our innovation model, if we have to lift our total factor productivity and put it on a different orbit than what we have today. And that's a conversation that is very essential and important that we must have. And that's a conversation between tech, based innovators and the economists. And they have to come together in fora and discuss this out. And I'm hoping if we do that, we will have new insights that will power the economy as we go forward.
Very good point.
Right.
Very good point. Sid, you want to summarize?
No, happy to. So I think in this entire panel, what we've actually seen, or the takeaway points have been, first and foremost, the fact that the rupee stability is something that all investors can actually choose to expect as of now. And this is a combination of both the macro factors, global factors, as well as India, as well as the Indian reforms that have happened over recent times as well. And the fact that unicorns and private equity has a very strong role to play because of the depression we've actually seen in terms of the interest rates, etc. That movement of capital is going to start happening. May not go to the public markets, but it's moving to the private markets. And all of us have seen numerous firms, much larger firms now actually hunting upstream, where the thesis is simple, that if it actually takes this company 5 years and let's say $500 million to build it, instead of waiting for that long, I'll give them the money upfront. And let's actually build that entire thing to a much greater extent. We've seen the weaponization of capital by the people who actually have capital. And as Mr. Soumyakanti Ghosh has also pointed out, India is not a country that's actually been lacking in capital to that extent. We just need the regulations and the framework to allow our banks and some of our largest savers to start marshalling that capital into the new age economy that's emerging as of now. And that new age economy, in order for the new age economy to also thrive, as Sharad also mentioned, our regulations need to change. And all of us know as a fact that innovation always outstrips regulation, and it's about time the regulation starts keeping pace. We have seen numerous reforms happen through the Atmanirbhar package in India from last year, where we liberalized large chunks of the economy and we started giving greater latitude to entrepreneurs to actually operate. I believe that should be the first step, and it's probably something we should actually rest our laurels on, and there's still a much longer way to go. And as Praveen has also mentioned, the demographics of the country, the demographic dividend that all of us have actually seen through is actually happening because of the democratization of economic development. And schemes such as the PLI, other schemes by the government, etc., have ensured that even that the capital development and the economic development doesn't become the mainstay of the top 5 or the top 10 metro cities in the country, but actually goes throughout the entire location as well. So one person had to travel, let's say, 1,000 kilometers for a job, can now actually just travel about 15 to 20 to actually reach where that's happening. And from the economic standpoint, I think one thing that all of us can agree is that forums such as this become even more important in order to ensure that the technologists and the entrepreneurs, the investors, and the economists can actually intermingle and actually start creating and actually start forming the thoughts or form the basis for the next year's investment thesis as well. I'm actually very hopeful that the economists on this panel can also prepare a report on some of the crystal ball gazing they've actually done, and we can see how entrepreneurs such as Praveen, etc., can actually end up utilizing that, and people like Sharad can actually end up creating the technology backbone when it comes to actually formalizing this as well. So those are my thoughts on this, Srini. Would love to get your thoughts also.
Sid, I would just add to what you're saying. I think there were two constituents who are listening to this panel, apart from other two important constituents, I would say. One is fund managers like you and me, the GPs, and of course the capital providers, the LPs. The good news, as far as the economists are concerned, what I hear them is that if the rupee is going to be stable and possibly, given all the stuff that they mentioned, could potentially even appreciate. I think the LPs should now be thinking of giving us capital with rupee as a hurdle rather than dollar as a hurdle. And they have made the case for making sure that that is an important thing. And from our perspective, with rupee as a hurdle, it makes our job that much more focused, because at the end of the day, even though we may like to build a portfolio where most of the underlying companies are getting a play on the potential movement of the currency, most of us in the previous decade have always bet on the fact that the currency will continue to depreciate. So you try and go for as much of export earning companies so that it gives us a natural edge on the portfolio. Those are the two important messages that I say. So I want the LPs to start thinking about rupee allocation, start thinking about India-specific capital allocation and a portfolio decision, and of course GPs to start negotiating harder for rupee hurdles. And it'll make life easier for everybody.
And the digital currency is also coming. The central bank digital currency, which can also change the rules of the game to a significant extent. So I think that's another development.
Yeah. Great.
Very cool. And I think that actually should form another entire panel in itself, because what the digital currencies actually hold as of now in terms of attacking the existing fiat structure is something that entrepreneurs have been pushing to a very large extent. And the tussle between entrepreneurs as well as the government and the established order when it comes to the means of currency, it's now become more abstract than ever, given the flooding that we've actually seen of capital throughout the entire world. That I believe is actually going to underscore the next decade when it actually comes to it. And there would be a lot more innovation and creative destruction, to actually borrow an oft-used term from economics, as part of that itself. And all of us on this call and all the people who are listening to this panel as well will actually end up becoming the players starting upon the stage who can actually make this work.
Great. Thank you very much. Thanks all of you for being on the panel today, and I do hope whoever is listening has gained from today's discussion. Thanks all. Thank you.
So I invite Rochelle from the from the team to actually come and actually take this forward and formally conclude the panel. Rochelle? I think we have that. Yeah, I think there are about another 10-15 seconds or something before they actually wrap up. They might have some sort of issue as part of that. So perfect, gentlemen. So any other last parting thoughts or something? We see that Roshal's actually joined us.
Oh, yes, I'm back. And it was a power pack session, gentlemen. So thank you so much for the time. And lots of insights for us, right? Especially with respect to, public goods and private innovation. I think that's the stack and that's the architecture on which most of the innovation is going to be built. Again, it's the maximum decade for India, and I guess all of you have been saying the same thing. So thank you so much for your insights and for your time, gentlemen.
Perfect. Thank you so much.
Thank you.
Bye-bye.